Welcome to our video comparing GAAP and IFRS, two major accounting frameworks. This content is for anyone looking to understand the core distinctions between these standards, especially students, finance professionals, and international business stakeholders. By the end, you'll have a clear understanding of their differences and why they matter for financial reporting and analysis. To truly understand financial reporting, you need to grasp the two dominant accounting languages: Generally Accepted Accounting Principles, or GAAP, and International Financial Reporting Standards, or IFRS. GAAP is primarily used in the United States, while IFRS is adopted by over 140 countries worldwide. Both aim to ensure transparency and consistency in financial statements, but they achieve this through different approaches. The existence of two major standards reflects historical development and differing philosophies. GAAP evolved from a U.S. context, whereas IFRS was developed to foster international comparability. Let's start by looking at their fundamental philosophies. GAAP is known for being rules-based, while IFRS is principles-based. GAAP provides detailed rules for almost every transaction, often leading to less room for interpretation. IFRS, on the other hand, offers broader principles, requiring more professional judgment in application. This difference affects how companies report their financial information, potentially leading to different financial outcomes for the same underlying economic event. Next, a significant difference lies in how inventory is valued, particularly concerning the flow of costs. GAAP permits the use of LIFO, or last in, first out, where the most recently purchased inventory is assumed to be sold first. IFRS, however, prohibits LIFO, allowing only FIFO, first in, first out, and the weighted average method. This choice of inventory valuation method can significantly impact a company's cost of goods sold and, consequently, its reported net income. Let's move on to how fixed assets are treated under both standards. Under GAAP, fixed assets are typically reported at their historical cost, less accumulated depreciation. IFRS allows for the revaluation of fixed assets to their fair value, which can lead to higher asset values on the balance sheet. Both standards allow various depreciation methods, such as straight-line and declining balance. However, IFRS emphasizes that the chosen method should reflect the pattern in which the asset's economic benefits are consumed. Another key area of divergence is the treatment of research and development, or R&D, costs. Under GAAP, R&D costs are generally expensed as incurred. IFRS distinguishes between research and development phases. Research costs are expensed, while development costs, once certain criteria are met, are capitalized. This difference directly impacts a company's reported profitability and asset base, as capitalization defers expense recognition. In conclusion, while both GAAP and IFRS aim for transparent financial reporting, their methodologies and specific treatments differ. Key differences include their philosophical approaches, rules-based versus principles-based, and specific treatments for inventory valuation, fixed assets, and R&D costs. Understanding these nuances is essential for anyone dealing with international financial information. Thanks for watching.